Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at 3 tech stocks to consider buying before earnings and holding for long-term upside. And those 3 tech stocks are AppFolio, Spotify, and Vertiv. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our Zacks.com/promo page for a look into some of our services, portfolios, and more. So before we jump into these 3 stocks, I quickly just want to go over what the market's doing as I record this midday Thursday. So the S&P 500 hit new highs as I record this after NVIDIA soared on the back of Taiwan Semi's impressive earnings results, with the chip-making powerhouse signaling strong AI-boosted demand. So that kind of helped people think, all right, we're going to have a good third quarter for a lot of these big tech stocks. Still, I wouldn't be too shocked if you see some more volatility in the coming weeks as Wall Street attempts to digest this onslaught of earnings reports from tech giants and other companies. There also could be some profit taking as we're at new highs ahead of the election, and that can be a volatile period. And October is already somewhat of a historically rough month for stocks. And on top of the S&P 500 sitting at all-time highs, NVIDIA is now back at all-time highs in CNN's Fear and Greed Index, which is a pretty common contrarian stock market indicator. So when it gets to greed, that's a good time to take some profits. And it's sitting just below extreme greed at the moment. So the NASDAQ, as I said, is just below its highs as I record this. It's up about 24% year to date, and it's up 45% off those October lows of last year. So we are on an impressive run. So you could see some volatility, maybe some profit taking, but still the overall bullish backdrop of solid earnings growth and lower interest rates should support the bull market going forward. So get ready to deploy some cash the next time, maybe in the market or one of your favorite stocks experiences a pullback. And some of these stocks we're going to dive into today are at new highs, and then one of them's at a price that might be worth getting into right now. So that first stock we're diving into is AppFolio, which trades in the ticker APPF, and it's set to report its Q3 2024 results on Thursday, October 24th. The company is a real estate-based tech firm that boasts that it offers one powerful platform for your entire portfolio. It helps streamline and automate real estate management, and then, quote, unlocking your potential and giving you more freedom to focus on what matters. So it helps property managers. Some of their offerings include accounting and reporting, maintenance and efficiency, staffing and training, marketing and leasing, management and growth, various things like that. Then there's property manager offerings, and then there's investment manager offerings. So various things to help people who are invested in managing real estate in the United States. They offer single family offerings, multifamily, student housing, affordable housing, community associations, and then commercial investment management as well. So overall, the business has been really booming over the last several years. The company did 32% revenue growth in 2023, 32% the year before that, 16% in 2021, 21% in 2020. So a really impressive stretch. If we go back to 2016, the company AppFolio did $106 million in sales. And last year they did $620 million. And if we look ahead, we're calling for another 25% growth in 2024, and then another 20% growth next year to get to about $935 million. So nearing that $1 billion threshold. And last quarter, the company, so second quarter, its total units under management grew by 9% year over year to 8.4 million. So that's a good number to pay attention to. And clearly their offerings are resonating with people who run and manage real estate properties, which is a big business in the US and other places around the world. And then on the bottom line, we're calling for really impressive growth. So we're calling for 146% adjusted earnings growth to go from $1.71 per share last year to $4.20 per share in 2024, and then another 30% growth next year to get all the way to about $5.50, $5.48 to be exact. So really strong top line growth, and then the bottom line growth is really, really impressive as well. Overall, its estimates for 2024 and 2025 have moved higher since the company reported its earnings last time around, but it has stagnated recently, so it lands a Zacks ranked number 3 hold at the moment. And it's worth noting, though, the company has crushed our bottom line estimates over the last 4 quarters by an average of 30%. So really impressive bottom line growth, even though it's stagnated a little bit recently. And then in terms of its stock price performance, AppFolio stock is up 125% in the last 5 years and over 1,000% since its IPO in 2015. The stock, though, is just up 16% year to date, so lagging the tech sector. And it suffered some huge pullbacks after its Q2 release. And then more recently, the stock's now down over 25% from its highs and trading 40% below its average Zacks price target here at the moment. It is also, though, over the last 5 years, sitting at some of its most oversold RSI levels. It is trading below its 200-day moving average, so well below its 200-day moving average. That said, it might just start getting some nibbles as it gets to, as I said, historically oversold RSI levels, which is a good sign if you're looking to get into some strong tech stocks with great growth outlooks that had been doing well. Now that the market's at all-time highs, maybe people are going to start taking some profits on some big winners sitting at new all-time highs and start looking for some of these stocks like AppFolio that have taken a dive recently and are now sitting at more attractive levels. That said, one of the concerns is it's trading at 52 times forward 12-month earnings, but it does mark a huge improvement from where it has been. And then overall, Wall Street's still really high in the stock. All 8 of the brokerage recommendations that Zacks has are coming in at strong buys, and it has a really impressive balance sheet with no current or long-term debt. So that's really a good sign for this well-run tech company that's operating in a growth area of the market, and it's somewhat nice niche there as well. And then in terms of forward sales, it's trading at a 54% discount at 8.2 times forward sales, which is not that much elevated from the broader tech sector, which is trading at about 6.2 times forward 12-month sales. So overall, AppFolio is certainly worth putting on your radar heading into its upcoming earnings release. And obviously, buying stocks just for a post-earnings release pop is always a risky scenario, since you never know what Wall Street's going to hang on, and maybe they have a great quarter, but the guidance isn't exactly what people are going for, or maybe there's more profit taking. So maybe you want to wait until after the report if you're trying to trade the stock exactly. But longer-term investors don't need to get too into the weeds of exact market timing, especially since it's sitting at some historically oversold levels. And now we're going to move on to Spotify, which trades in the ticker SPOT. So at the moment, our Zacks calendar is a little off. I'm going to correct that after I record this and point it out to some people. So at the moment, it says Spotify is reporting next week, but the company said that it's reporting its third quarter results on Tuesday, November 12th, so several weeks from now. But I still want to highlight it as a stock to consider buying before earnings. So overall, the bull case for Spotify is as follows. It's one of the pioneers of the paid streaming music industry. The company altered the music industry in the same way that Netflix changed TV and movies. Like Netflix, Spotify's success has inspired challengers such as Apple, Amazon, Alphabet, all in the streaming music space. Despite, though, the competition from those giants of the entire tech space, Spotify remains the king of streaming music. Spotify reportedly held 32% of global streaming music market in 2023, blowing away number 2, Apple Music, at 15%. And then Google's YouTube streaming paid service was at about 14%, and Amazon was around 13%. So roughly, just crushing nearly or more than doubling all the other big tech competitors. It's also thriving as users flock to the service for music, podcasts, more recently audiobooks. It's nearly doubled its revenue between 2019 and 2023, and its premium subscriptions grew by 80% between the second quarter of 2020 and the second quarter of 2024, with monthly active users up 110%. Spotify is projected to grow its monthly active users by roughly 45% to nearly 900 million by 2028, based on some Wall Street estimates. And its user growth expansion is key to helping it continue to negotiate really favorable rights deals with artists. The streaming service often becomes a central aspect of people's daily lives. I know I'm a big user of Spotify. And then it's been able to help, that backdrop has helped to be able to successfully raise prices back-to-back years. So the summer of 2023, it hiked its monthly prices for its ad-free premium plans to match some of its competitors. And then June of 2024, it upped its prices again to keep up with inflation and boost profits. Speaking of the higher interest rates over the last several years, obviously they're going down now, sparked Spotify and a ton of other companies to focus heavily on efficiency and the bottom line. So they have cut down on their workforce and rolled out other streamlining efforts that is paying off in a big way. So if we look ahead to this year, we're calling for Spotify to swing from an adjusted loss of $2.95 per share all the way to positive earnings of $6.24 per share. So a roughly $3 per share loss to over $6 per share in positive earnings. And then we're calling for another 40% growth on the bottom line next year to get all the way to $8.72 per share. And then on the top line, we're calling for nearly 20% revenue growth from about $14.3 billion to over $17 billion, and another 15% growth next year to just a tick under $20 billion for 2025 revenue. And this would come after 16% growth in 2023, which actually outpaced 2022 by a significant margin. And if we look overall to its earnings revisions over the last year, its 2024 estimates up 300% over that stretch. And then if we look at 2025, its estimates up 163% over the last year. That said, some of its most accurate estimates have come in slightly below consensus for 2024 and 2025. So that's not the best sign overall, but overall, they're still up huge over the last year, and the company has crushed their estimates in the trailing 2 quarters by 32% last quarter and then 67% the quarter before that. So that's a positive sign there for Spotify. And then in terms of its price performance, the stock's up over 370% off its late 2022 lows, including a nearly 100% year-to-date climb. And it finally broke above new all-time highs just several weeks ago, surpassing its previous 2021 records. And then in terms of some technical levels, as I record this, the stock is trying to find some support at its 21-day moving average, trading at roughly neutral RSI levels. So if things go well when it reports in a few weeks, it could possibly break out again. But it wouldn't be shocking if maybe there's some more profit taking after this incredible run. So if you want to wait until maybe it falls back down to that 50-day or even maybe the 200-day moving average would be kind of a screaming buy for Spotify considering its outlook. And then in terms of forward earnings, it's trading at a 75% discount to its 12-month highs at 45 times forward 12-month earnings. So that's still high, but if we expand that out, factoring in its PEG ratio, which factors in its longer-term earnings growth outlook, it marks a 50% discount to the tech sector, which is really impressive. And then in terms of forward sales, that's trading at a 40% discount to the tech sector and roughly 40% below its own highs. So its valuation looks really solid, even though it's been on a really nice run to all-time highs. And then when we look at brokerage recommendations that Zacks has, so of the 30 brokerage recommendations, 20 are coming in at strong buys, with 7 holds, 2 buys, and only 1 strong sell. So Wall Street's still really high in the stock. Overall, as I said at the top, Spotify has reshaped the music industry the way Netflix permanently changed Hollywood, and its valuation's improving. So now would be a solid time to at least put Spotify on your radar. If you want to wait for a pullback after earnings, certainly worth considering at the moment. But overall, Spotify looks like a nice long-term buy and hold tech stock in a space that's growing, and it's proven already that it's able to outpace its big tech competitors. And now we're going to turn to the last of our 3 stocks, and that is Vertiv, which trades the ticker VRT. It reports its third quarter results on Wednesday, October 23rd. Vertiv is a picks and shovels AI stock that has partnered with the current king of AI, NVIDIA, and will grow pretty much no matter who eventually comes to dominate the world of artificial intelligence. And that's either 5 years from now or 20 years from now. So Vertiv's power, cooling, and IT infrastructure solutions and services operate across data centers, communication networks, and beyond. The company helps computing power needed to drive the modern economy run as smoothly as possible around the clock. Its categories include critical power, thermal management, racks and enclosures, monitoring and management. So at the same time, it offers various other services. Overall, though, it works with small, medium-sized businesses and enterprises across a range of areas of the economy to help all their computing power run as smoothly as possible around the clock. So Vertiv grew its organic orders by nearly 60% in the second quarter. The company pointed to increasing scaling of AI deployment as a big reason for their future growth, and they're ramping up capacity. As I mentioned as well off the top, they have partnered with NVIDIA to help solve some future data center efficiency and cooling challenges, as just the AI ramp up is leading to just massive amounts of computing power, and we need to figure out how to keep those running as efficiently and smoothly as possible. Vertiv's earnings estimates have jumped since the second quarter release, extending its impressive stretch of upward revisions over the last roughly 2 years at this point. Its improving bottom line outlook helps it land a Zacks ranking number 2 buy at the moment, and it's topped our estimates by an average of 13% in the trailing 4 quarters. If we look to our estimates for 2024 and 2025, we're calling for 13% revenue growth this year, and another 14% revenue growth next year. And then the bottom line, we're calling for 46% adjusted earnings growth this year and another 30% next year. So really strong bottom line growth supported by impressive top line growth as well. And then in terms of its performance, the stock has soared over 1,000% in the last 5 years and roughly 900% in the last 2 years. And it's up around 140% year to date. These runs put Vertiv or have the stock blowing away other tech giants like Meta and others during this strong run for tech stocks. And then in terms of technical levels, it could face some selling pressure. It's trading at new all-time highs as I record this, and it's well above its 21-day moving average and trading at some somewhat overheated RSI levels, so overbought RSI levels sitting at 74, with 70 being the threshold of what's considered, quote, overbought there. So we could see a pullback. So maybe you want to wait until after it reports and after there's a possible pullback. But on the valuation front, it's still trading at a 10% discount at its highs, despite trading at all-time highs at 35.1 times forward earnings. And overall, the constant expansion of data centers and the rise of AI systems, cryptocurrencies, and other new technologies that require a lot of computing power give Vertiv a massive growth runway for decades. And this is why Wall Street's really high in the stock. So all 12 of the brokerage recommendations Zacks has are sitting at strong buys. So certainly worth putting Vertiv on your radar heading into its earnings release next week. And maybe you want to wait for a possible pullback. But if you're a longer term investor, now might be just as good a time as any if you're thinking about holding Vertiv for 5, 10, maybe even more, 5, 10, 20 years, something like that. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.